welcome to Storyboard. Every year at Cannes Lion, there is one day in a week that we have an interaction fixed with a man that we love to have on our show. That man is Sir Martin Sorrell.
You say that to all the boys.
Not
me.
At all, just
you
to you.
Say that to everybody.
So we have one day of the week fixed for an interview with you, ear on ear, and that day remains the same.
Right, Saturday morning.
Saturday morning, indeed.
Right.
So welcome to the show.
Thank you. Good to be here.
Before we get on to Cannes Lions and the developments around advertising, I would like to speak to you about Brexit.
Yeah.
What do you think of it and what impact will it have on the UK economy?
Well, it's not good news. I mean, it's not good news, I think, for India. It's certainly not good news for the UK. We'll see a reduction in the GDP growth rate in the UK. I'm not saying that we'll go negative or into recession, but I think we'll see a reduction in the growth rate. We were doing very well pre-Brexit. The referendum vote itself slowed the growth, I think. We saw some impact on advertising spending. From the announcement, you saw ITV's announcement or comments that it had some impact. We've seen it with newspapers, I think, as well. So it'll have an impact on the UK. With the biggest impact. A secondary impact on the EU, which will grow more slowly as well, and Western continental Europe was in a recovery, and it'll continue to recover, but not as quickly. And the world will suffer a little bit, and the reason being, uncertainty is heightened. Uncertainty is the enemy of growth, and this just introduces a whole slew of uncertainties. It's not just the Brexit vote, which in and of itself I personally thought was a disaster. As a result, but it also will trigger a number of demands already for referenda in the EU countries.
Yes, exactly. That's
demands for referenda in the Union, Scotland, Ireland, Wales. Even I saw that somebody was demanding independence for London. I think he got 90,000 signatures for that London should go independent and secede and go off with the EU. So it's a nightmare.
What will be the impact on WPP's business?
You know, at one level, you've seen the impact already. Share price fell by about 4 or 5% yesterday, probably a little bit less than we thought it was going to do. Currency has had a major impact on the value of the company in America, where in dollar terms it's fallen in value. But the irony about this is as the pound weakens against the dollar and against the euro, our reported sales and profits rise. So there's a counterbalance here, which is quite interesting. So 90% of our revenues and profits, or thereabouts, come from outside the UK. So we're very well positioned to benefit from overseas expansion. So those are the immediate impacts. In the longer term, what it means is that we have to really emphasize our strategy. And if you look at the Western continental European markets of Germany, which is our fourth largest market, France, number 6, Italy, number 9, and Spain, number 10. So 4 of the top 10 markets. US is biggest, UK is second, Greater China is third. So effectively 5 of the top 10 markets are EU, or were EU. Now it's 4. And those 4 are really important economies, all with GDP of around 2.5, 3.5 trillion. And what we have to do is, they're important to us, we have very strong businesses in all of them, we have to make them stronger, and we have to be faster. So the irony of the Brexit vote is we're going to put more emphasis on those markets. Does it mean loss of jobs in the UK? No, but because the rate of growth will slow, it'll mean that the increment of jobs in the UK, we have 17,000 people in the UK, it's grown by a third over the last four years, which we're very proud of as the business has grown so successfully in the UK, will grow in the UK, I'm sure, but we won't add as many jobs in the UK as we would have done, and we will add incrementally more in Western continental Europe. As far as the strategy is concerned, it's got to be more bricks and next 11, because one of the arguments of the Leave campaign was that there's the big opportunity in India. We don't do well enough in India as a country. We do brilliantly in India, and you know, over the years I've got increasingly proud of our business in India, and we'll have another very good year. Already have had a very good year. We'll cross $600 million of revenue. Last year we crossed 500 million. So that gives you an idea of how many, you know, we've got 15,000 people almost now in India. So it's a phenomenally strong business. It continues to grow. across the board, whether it be advertising, media, data, public relations, branding and identity, healthcare, digital. So a phenomenal business, and I wish, as I've said, I think 20, 25 years ago, if our business was as good everywhere in the world as India, I could retire. So
that's good news for us.
Yeah, it's good news for me. Well, it's probably not good news for me, but anyway, but it's really, super business doing it extremely well. But we have to do better, and we have to do better in Brazil. We have to do better in Russia. I'm talking as a nation. We have a great business in Brazil. We have a great business in China. China obviously has got challenges. Brazil's got challenges. Russia probably has the most severe challenges. We're almost going into a second Cold War.
You slowly start shifting your focus towards more focus towards these
the irony is, yes, so it'll be the fast growth markets, which are a third of our business, and we want to be at least 40 to 45%. It'll be digital, more digital, so it's 40%. That's where the growth is. So, probably that we'll revise the target up to half of our business. And then, last but not least, the emphasis on data, which is 25% of our business. Strong business in India. We're back again in the TAM business there, the television audience measurement business there. And last but not least, and probably ironically or paradoxically the most important of a strategic objective, is to get what we call horizontality, to get people to work together more effectively and efficiently for the benefit of clients at a time when we're voting in the UK for isolation. I mean, the whole thing is crazy at that level, but we want our people to work together, and we've got the British electorate, bless them, perfectly entitled to make that decision, saying we should become more isolationist. So really, really sad, actually, very sad. I mean, I think my reaction on Friday morning when I woke up at 5 o'clock, when I went to bed, I thought I saw the Newcastle result and felt this was going the wrong way, and woke up at 5 o'clock and saw that it had gone the wrong way. And I think sadness, disappointment and sadness, because I think it really is the wrong way to go. It's not the way the world needs to go, and the reaction from Juncker this morning is not good. He's digging in, and I can understand in a way. We've rejected the club. We've decided to be outside the club, so he's saying, let's get on with it. And that's not good news. And the Prime Minister's resigned quicker than I expected. I thought he might stay for a little bit longer period, but obviously he was very emotionally disappointed by it. I think there's a lesson there. You should take 24, 48 hours. When these sort of things happen, maybe you should take 24, 48 hours to reflect, and not in the heat of the moment decide instantly. But it's a bit chaotic at the moment.
Do you think UK is headed towards a recession?
No, I don't think so. But the rate of growth will slow. So there's no doubt about that. Some of the projections you see taking down a 2.5% GDP growth significantly, but not negative. And neither do I think Western continental Europe will go into recession. You will have countries that go into recession. Russia's already gone into a recession. Brazil has already gone into a recession. And there will be other countries that do. But I think the world will not. Britain will not. And the EU will not. But it will slow. And the stock markets are reflecting that.
We're getting into the 7th month of the year. What is your prognosis for 2016-17 as far as media business, media and advertising?
Well, the world's growing at 3.5%. We're doing much better than that. We're doing double digit in India, so India is a shining beacon. But the world's growing at 3.5, 3 being real, nominal being 3.5. That's what the industry is growing at. Advertising proportion, GMP, in the slow growth mature markets is still probably growing less than GDP. In the fast growth markets, more. The BRICS have slowed. But the next 11, as we call it, Vietnam, Philippines, Indonesia, other markets like Mexico, Argentina, the Macri effect in Argentina. Macri reminds me a little bit of Modi, both initial names M. But the Macri effect in Argentina has been phenomenal. We're running an investment conference down in Buenos Aires in September. I think it's the 12th and 13th of September. Argentina open for business. So there are parts of the world that where we can be much more optimistic about. But the big engines, are spluttering. The one engine that's still going of the BRICS or the BRIC countries, is India. But 3.5% growth, I think that will be a very similar picture, maybe a little bit less because of Brexit this year finally, and a little bit less next year because of Brexit. But basically low growth, moderate growth, low inflation, and therefore little pricing power, and then a focus on cost. I mean, the world is far too short term. This is the biggest issue. And the Brexit creates uncertainty. Uncertainty is the enemy of growth, so it's going to make it, this conundrum of breaking out of this low growth trap, even more difficult to deal with. So we just have to stiff upper lip, as the British do, put your tin hat on, and try and cope with a difficult environment. I think it's too short term.
That's a good way. That's a good approach. CEOs last for about 6 to 7 years on average. 5 to 6 years of CEOs 6 to 7 years, CFOs 5 to 6 years, CMOs 2 to 3 years. So they tend to think in those chunks. If you look at the S&P 500, it's distributing more than 100% of its retained earnings in dividends and buybacks. So the S&P 500, that's what it did in 2015. So what it's signaling is management signaling that they're better to return the profitability to shareholders, decide what to do with it, than make that decision themselves. So they're shrinking effectively. That tells you how short-term the attitude is. We, on the other hand, believe in brands. You believe in brands. CNBC better believe in brands and in innovation. And if I look at the top 100 brands that we survey every year, and if you and I invested in the top 10 for the last 10 years, we would outperform the MSCI index by 300% and the S&P 500 by 75%. So investing in strong brands that grow the top line faster, which is the reason why share prices rise faster, and innovate more, that's what wins. Cutting costs, you can't cut your way to success.